Hello everyone, and welcome to another online meeting on behalf of American Petroleum Professionals of Iranian Heritage. The APPIH is our great honor to start another panel discussion in the future of. Before starting, just a short announcement. First, during and after discussions, you can write your question in the chat box. And please switch off your camera and microphone from now. Second, a recorded version of this panel discussion shortly after will be available in the APPIH social networks. Okay, let's introduce today's moderator. It's our great honor that today we have Mr. Fred Arasteh as moderator. Fred is currently as a reservoir engineering supervisor at Vallco Energy. He is graduate of Mining University of Leoben in Austria, a highly experienced reservoir engineer with past experience at PHP, Weatherford, and SLB, working on conventional, unconventional, domestic and international. He is a past president of APPIH and current board member. I would like to thank Mr. Arasteh for accepting our invitation, and without further delay, I'm transferring session to him for starting the panel. Thank you.
Thank you, Dr. Samoui, for your kind introduction. Before we get started, I would like to introduce our panelists, and then I have a quick introductory comments about where we're going, and we're going to have two presentations, and then that will be followed by the Q&A session. Thank you for everybody to joining our panel discussion. This is a continuation of our first session a couple of months ago. So by the alphabetic order, I start with Dr. Mahmoudkhani. Dr. Mahmoudkhani is a director of technology at Locus Bioenergy Solutions. He successfully managed several upstream oil field application development projects from concept to lab and field validation and commercialization. He's an inventor and co-inventor of 38 patent applications in oil and gas, author and co-author of 126 publications in peer-reviewed journals and proceedings of international conferences and meetings. He has a solid background in the chemistry of materials and broad knowledge of oil field chemicals and chemical treatments at gas, liquid, solid interfaces. And he has a strong experience in methods for water treatments and reuse. I recommend to check his LinkedIn page to get more familiar with his background and his interests. Our second panelist in the row is Dr. Iman Nasseri. He is a managing director and of the Middle East, is based in London. He received his PhD in economics in the United States, and he's focusing on energy economics, has been doing that. He is working with the company called FGE. He is primarily focused on downstream oil and gas, specifically LNG, liquefied natural gas industry. On the oil side, Iman is responsible for Middle East oil research. He works closely with the refining teams and is involved with FGE's annual World Refining Outlook. On the gas side, Iman works with the global gas team based in Singapore to manage clients. Last but not least, Mr. Farrokh Pebdani is a highly experienced oil and gas consultant. He's a graduate of University of Texas and Louisiana State University with bachelor's degree and master's degree of sciences in chemical engineering. He worked for ExxonMobil International for over 20 years, retired in year 2000. And since then, he worked for Aramco for 10 years in reservoir management and research positions. And he's the founder of Reservoir Transformation Group in 2012, a consulting company based in Texas, which has been working mainly in field development planning in the Middle Eastern countries. And again, I'd like to refer for more detail to his LinkedIn profile. I'm very honored to welcome this highly qualified panel here. To get our discussion started, I would like to maybe give a glimpse of where we are today. As most of you know, rig count is some sort of measure for level of activities in upstream oil and gas industry. And I have a quick slide, high-level slide that shows where we are today compared to last year. And maybe a glimpse back to our first session we had a couple of months ago. That was where we were hit with the first wave of coronavirus. Everything was shut down. Logistics was shut down. The market was crashing. And I think it was a few days after we had almost negative crude price in the US. So at that time, we really didn't know where we were going. And the very interesting discussion we had was a mix of feelings. Today, when we look at the picture, the tables, the table we have in front of us shows big drop compared to last year, but which in the US is almost 70% down. In Canada is even worse, almost 80% down. And internationally is probably much better picture, but still in negative territory of almost 30% down from last year. I'd like to go to my next slide, which shows a little more of a historic situation. And this next slide shows basically the activities since 1987. 1987, if you're as old as I am, probably you experienced the big crash in oil price in 1985. And then following that was a long journey of stabilization. In 1999, we had another downturn, but then the rig activities started to pick up, followed by really good times since 2007, 2008 in both oil and gas sector, peaking in 2014. I like to get your attention to the last portion of this curve, where we almost are at the same levels of activities in early 2000s. But even though the last piece is a big drop from where we were a few months ago, but there are indications of stabilization in the last few weeks. The activity seems to be basic. The big drop seems to be bottomed at this point, and oil price has stabilized at around $40. I think, and we are going to have this in the discussion going forward, that things seem to be going in a positive direction, knocking on wood. So with this quick introduction, without taking too much time of our panel discussion, I would like to move on and to our panelists. We are going to have first a short-term analysis, short to middle term analysis of where we're going currently with the market trends. The crude price is a very good indicator of where the future is, where the activities are, and that's going to be by Dr. Nasseri. And second, after that, we're going to have a presentation by Dr. Mahmoudkhani, who his interest and focus is more towards the longer term macroeconomics and alternative source of energy. So with this, I would like to pass on the mic to Dr. Nasseri, and with his very interesting presentation slides.
Thank you so much, Fred. Let me share my screen with the audience here. I hope everyone's able to see the slides that I am going to present. I have 6 slides that I would like to use to present the current state of the market as we see it, and a little bit of what's happened so far, how the rest of this year is going to look like, and then the recovery path, short term and a bit longer in future. So in 2020, the pandemic, the COVID-19, basically overtook the oil market. By all means, many factors were in play already in different parts of the market. There was an IMO 2020 that basically the oil market was dealing with, trying to sort out, trying to work through, as well as basically some other demand and supply factors. Already the market was in an oversupplied situation. OPEC and OPEC Plus were trying to sort that out.
Dr. Nasseri, sorry, maybe you selected the wrong display. Would you please select the, okay, that's right now, it's fine. Okay.
Okay, so for whatever reason, the sharing had been paused. Yeah, basically the COVID came and overtook all the factors, destroyed the demand significantly. We know that April 2020 was a disaster that had never happened in the history, but also the recovery is taking much longer than perhaps people anticipated, including ourselves, when it all started in January and February. For that, 2020 as a whole is going to experience a massive drop in demand, but that is not basically homogeneous across different products and different regions, as we have highlighted here. And this is a demand forecast and basically backcast. The first half of this year is a bottom-up approach. So we basically collect information by product, by country, and then add them up. And this is how it looks. In 2020, jet fuel and kerosene, which is the same, have been hit the most. Everyone knows why. Followed by gasoline. So basically fuels that move people around have been hit most. But also regionally, if you look at the chart on the right, you will see that Europe and North America and Latin America perhaps were among the worst hit regions. Also, recovery, as we forecasted next year, is going to be similarly not equally across the barrel and across the world. But also one perhaps more important feature is that next year we won't go back to 2019. So all of the impact that we basically we expect 2020 to have had is not going to fully recover. And our basically points where demand goes back to a 2019 level is mid-2022. So longer term, again, this is demand. So short term, we talked about demand, and long term, as you see in this chart, 2021 still below 2019, and 2022 at some point we get where we were and continue the natural growth or what's growing oil demand economically and industrial activities and all of that. But perhaps at slower rate and definitely below the path that we used to expect, or we had forecast last year, for example. You see the dotted line is where the oil demand was going in April 2019 on our books. We expect the oil demand to peak in early 2030s. So previously we had it in 2031, 32. It may in fact be a slightly delayed to 33, 34 because of this impact of the COVID-19. But this massive drop was in fact supposed to be matched with a drop in supply. But OPEC wasn't enough. The size of OPEC production wasn't enough. So they had to team up with a lot more countries in the OPEC Plus, and they decided that they could cut basically near, let's say 10, and together maybe closer to 15 million barrels per day. But they decided that too late and too little. So what happened is that because they did not react quickly and enough to the demand, we started to build inventories across crude oil and products. And that inventory level, as you see in this chart, basically have hit an unprecedented high level. In number of days supply equivalent, as the industry is looking at it, we basically approached 85 days of supply, global supply, or OECD supply, in terms of inventories. And that's why the demand, the price dropped to less than $20 on average in April. Going forward, what I have presented here is our forecast for supply and demand based on their factors and our assumed recovery rate of demand, and basically the decisions by the producing countries in the OPEC Plus and those which are not in this basically group. And what it shows is that the stocks, first of all, are not going to go back to 60 days cover, which is a standard OECD company, OECD stock level in terms of days supply, but also it will take basically by the end of 2020 and certainly not by the end of 2021, we're going to come back, but it will kind of flat out only early 2021. Hence, the oil price recovery will take its time to come back to near $50 by the end of this year. That's our price forecast, which is fundamentally driven. So it's based on fundamentals. The market has so far been reacted to a lot of news in the market and emotionally driven in certain points in time. For example, that negative price in April for WTI was a panic-driven price. It wasn't necessarily fundamental driven. Hence, it basically corrected itself in a day or two. So that's our short-term price forecast based on fundamentals. If you want to know how we see it long-term, because we follow the same procedure, the same structure or system for long-term demand and supply, we don't think we will ever see $100 oil price again. Our price forecast, again, you see the dotted line, it goes up and down purely based on fundamentals, how the oil supply and demand interact with each other. But the two scenarios that, what if the oil price, is there a scenario that oil price drops to much lower prices of, let's say, $25 to $40? Yes, only if basically oversupply takes over, and that can easily be done by Iran, Venezuela, Libya coming back to the market. And if there are demand shocks or supply shocks, negative supply shocks of, for example, if there's a change in policy, in US policy, and fracking is banned, that kind of supply shock is going to shoot the prices up to $100. But that's a very unlikely scenario in our case. Why do we see prices bouncing between 50 and 70? Because these floor and ceiling, in our opinion, triggers a supply cut or a supply abundance in the market because of how economics of supply works in basically how we see it across the globe. There are some basically more expensive projects which react first, but they are less contributing to the supply pool, and there are some very low price supply which react last. But nevertheless, the interaction of these two scenarios suggests that we're going to stay between 50 or on average $60 for foreseeable future. One last comment before I basically conclude my presentation here is that US, it was the nice chart that Fred showed to you, basically presented the rigs in the US and also international, but US specifically and the fracking and shale oil and gas is a very fast responding element of supply to prices. And there is a kind of delay which is caused by hedging, but that's also 6 months, maybe up to 12 months. What we know, and this is based on those companies that you see in the chart and many more that are not here, filing their basically financial report, is that $30 to $35 is the net back price for tight oil producing companies in the state. And if the price drops below that, you definitely will see a reaction in the supply. And if the price goes above, say, $35, as we are today, it will take some time for some of these companies to react in terms of bringing supply back, but definitely $40 and more, and perhaps as we approach $50 is when we see the valve is open and the oil comes back, the number of rigs will come back up. On that chart that Fred showed, there is also similar pattern in 2015 and 16 when, again, the price dropped and then price came back. You will see that how rigs also recovered. So with that, I want to stop here and pass it to Dr. Mahmoudkhani, and then we'll have a discussion, I guess, afterwards.
Thank you very much, Dr. Nasseri. That was very interesting. I always have a lot of respect for analysts like yourself who, try to forecast the price, because you're 100%, not 100%, but highly percentage that you're going to be wrong, right? It's always, that is reflected in your forecast, where you see the big difference between the low side and the high side, right? This shows the wide range of possibilities. So
absolutely. So one comment, we always say a good forecast is what that never happens. When the forecast is right, the market reads it and react to remove the imbalance that you're basically giving them a signal, and hence the market corrects itself, and it never happens. So right. You're right.
I mean, as a reservoir engineer, I'm in the business of forecasting, but forecasting volumes, which is much easier. And I guarantee you, I'm always wrong. I never forecast 100% correctly. So, but the good help is that range, to define the range, right? So with this, I like to move on to our next presenter, Dr. Mahmoudkhani, and he has a very interesting set of slides to go through, so I invite everybody to stay with us and follow this. Dr. Mahmoudkhani, you have the mic.
Thanks, Fred. Thanks, Iman. Good afternoon, everyone, wherever you are. I like to present to you, some of my, the way I see the future of the oil and gas. And I want to focus on maybe the one key question is that what is changing? I apologize, you don't have my video there. Somehow my laptop is not functioning. I forgot to bring my other camera. But you see that my picture before the COVID-19 up there on the right side. And if you, it's actually looking like that now. So anyway, without further ado, I want to ask you, think about one question. Is that, have you ever thought about what's the top selling mobile phones? Do you have any idea? Have you ever thought about that question? If you haven't, and if you haven't thought about it, of course, I'm sure, a lot of us are using the smartphones these days, yeah? But this is actually what you can find in the public domain, you know. And if you look at the top 10, you immediately notice that 8 of the top 10 sold mobile phones were belonged to Nokia. Amazing, right? And if you are old enough, like what I am, is you probably remember this type of the cell phone before, right? You know, amazing phone, no problem with the reception, you know, battery lasts forever, you know, type of thing, you know, and even if you fall, never, you know, I've never had any issues of breaking, you know, need to change the filter, things like that, right? Amazing, right? This was the market cap for Nokia. At some point, I hope that you see my crosshair here. You know, at some point around 2007, the market cap for Nokia was ranging around $150 billion. So it's a Finnish company, base company, technology, you know, a lot of patents, things like that. But what happened was that something major happened for Nokia, right? I'm sure you have probably seen the video of the Nokia CEO at the time around 2013, which was acquired Nokia by Microsoft. You know, at the time they were handing over, they gathered their employees and, you know, actually to, you know, presenting what's happening. And they said one thing which was struck my mind forever. And that's what he said, we did not do anything wrong, but we lost, right? The story of Nokia is quite compelling, and I would recommend each of us to revisit that every time, right? Imagine that you have a company such reputable in the world, has shared at some point about 41% of the mobile phone in the world was Nokia. I traveled across almost all the continents. Even I went to middle of the Africa, you know, those in the middle of nowhere, you still find the Nokia phones and still working, right? The interesting thing was, you know, they have a nice business model. I said it was sold, you know, the top selling mobile phone, things like that. Everything looks, you know, flourishing, gloomy, things like that. But one thing that they missed is that the world was changing and they did not capture that change. And that is something which I've tried to do for the last, you know, 5-10 years of my life in the oil field, try to really pay attention to, because this is really important, right? And not only important because to survive, but also how to look at it and how to thrive and how to actually grow, right? So the key message I want to tell you about the Nokia is that if you don't change, you know, you shall be actually removed from competition, right? Okay. And let me go back to a little bit of the history. I love history, you know. Part of that things, if you remember, like, you know, 1800 type of range, you know, the world was, you know, captured. Most of the things was about the coal mining. Everywhere in the world was doing that because, you know, during this industrialization, we needed energy and coal was the best one to do. But what happened was during the late, 1900s, we started to see the oil production, right? The beginning one in the Pennsylvania, 1859, followed by 1901 in Texas, you know, the first oil discoveries, right? Perfect, you know, I highlighted some of those, you know, traces from the history. Look at that, you know, what we have is adaptable and flexible, right? It was amazing. And the other thing was the oil was much more reliable and relatively inexpensive compared to the coal and whale oil that they were using. Just imagine again at that time, if you had to kill the whales and to extract the oil and use it for, you know, for the fuel and, you know, for lighting and burning, you know, cooking in the home. Now you're changing that, some form of environmental, you would say, an aspect to the oil at the time, right? Other thing was a technological breakthrough. That was the interesting one. And of course, that quickly become preferred energy of source. At the time, you know, a lot of other things happening around the world, including the electric light bulbs, including the automobile, that they did what they needed to do for the cars. They needed to some form of fuel, and the gas was the best one to do, right? By 1919, gasoline sales exceeded the kerosene, which was extracted from that coal and other stuff, right? And oil-powered, you know, ship, trucks everywhere, you know, and then you might imagine how exponentially that, you know, our industry evolved, you know, around the world, especially during the World War I and II, you know, by using the petroleum, right? If we look at the historic data, you know, for the oil production from 1920 to 220, there are two bumps in here. And the one is around the 1917 and 18, right? And that was the time we started to drill and started to tap into conventional. Everything was fine in the US. We were producing quite close to 10 million barrels per day, but then started to decline, go down. Of course, there were several factors in there. But again, starting from 2010, upward, something major happened, and then we start increasing the production of the oil. It becomes extremely important. And there were so many factors involving. Part of it was the energy independency for US, right? And trying to actually not to import it enough and get into where we are now with what we call it the unconventionals. So everywhere also pretty familiar. Definitely there are so many things out there in terms of the unconventionals versus the conventional reservoirs. We know there are so many vast measure of the reservoirs that we have out there are unconventionals, very tight. We needed high technology to do that part. And if you look at how it evolved, portion of what we achieved from unconventional was quite substantial. Especially if you look at it, by 2020, end of 2019, almost 65% of our production was coming from unconventional, right? And thanks to horizontal drilling and fracking. And you all remember at some point was drilling baby. It was everywhere, right? You're seeing the drilling rig going around, a lot of frac crews and a lot of these pressure pumping companies, growing in US and of course also around the world, right? Okay, great. I'm going to give you a little examples to tie into what Iman presented before. A typical drilling and completion of the gas, shale in a well, it costs around 10 million barrels, $10 million, right? Assuming that, I want to do some form of cash calculation and a return of investment, assuming that I'm going to generate 400 barrels per day, right? I can take the calculator and do the simple calculations, right? So if I have around price of oil or WTI being around $100, then if I only produce 100,000 barrels, I would be break even. I have, basically recovered my costs, initial costs within 8 months. If the production is around 400 barrels, and I'm good, right? $80, it still looks, reasonable. 10 months, I can get my investment back. $60 is not too bad, but starting 40 and down from that point, then you're start to becoming, really questioning, am I putting my money in the right place or not, right? Okay, fantastic, right? But that was based on the fact that from the day one, I continuously producing 400 barrels per day, right? But the reality was different. If you look at this top 5, formation share players we had in US, they were like, have a peak, reaching out within a few months, usually around 6 months, you get the peak oil, and immediately after that, you have this massive decline, right? Well, industry somehow managed to hide that things by investing, by capturing more money in, bringing more money in and more investment and continue drilling, right? So this was an easy thing. I get the money because it's easy available. I go to the bank loan me money, I can go drill a new well and I'm start producing, to that level, right? That was part of it. The other part of it, of course, as you know it very well, is that we have some, if we have some lease, agreements. According to similar lease agreement, I have to drill and I have to complete some of the wells and things like that, right? So great, but I want to say that the shale production or US production has some challenges, and that was started pre-COVID-19. It wasn't, what I see is that the COVID-19 just accelerated the problems that we have had for the shale production. And beginning 2019, the Wall Street Journal published, an interesting article which actually started to have that discussion around the news and social media that actually the money that was spent and invested in the shale oil is not paying back, right? And there's a problem with the shale. Mainly because, yes, we have the vast majority of our formations are unconventional, but our recovery factor, even at the present technologies that we are applying to, right, is only less than 10%. The best is probably 8%. In a lot of cases, we are even at like two digits, the 2% values, right? There's a steep decline, and we also have what happens within that regime for the last 3-4 years. The industry focus was actually trying to do focus on the cost of operation, living with the cash flow, how much they can produce and how much more money they can generate versus the new drilling activity. So that's what's happening. So if you look at even the last 4 years, you notice that steady decline in terms of the new drilling activity, right? So there are two factors nowadays that are important. Dollar, right? The investment, where the money is coming. So and where's the, how the money is spent. So a lot of these land producing companies, the small and medium size, even the big size, are focusing on the cash nowadays, right? So rather than, as we said, especially now within that oil price where we are in the $40, in terms of new drilling activity, it's not much, right? Compared to what it was before, it's nothing, right? And at the same time, trying to optimize it, we know about all of those things that we talked about, the automations, we bring in AI, things like that, just to reduce the costs, right? And the second big key here we have is the ESG, right? I want to talk about the ESG performance index because nowadays, if you look at most of the big and even medium-sized companies, they're focused on improving their ESG performance index. And why is that? Because that has become the key for new investments, right? The key because a lot of emphasis nowadays is especially from the shareholders and from those who bring in money to the table, is on the environmental part of it. Looking at how we manage the resources that we have, the emission part of it, the environmental issues and things like that. The social is also another factor in the governance, right? And that's actually becomes quite important now. And also you saw a lot of news, and I tried to share some of those information which is coming up in the industry about CO2 emission. A lot of things is going around that one. You heard about the methane emission. This is one of the top keys, especially for land operators. They're trying to reduce their emission. And of course, you heard about all those, initiative coming out from the big independent companies about the net zero by 2050. Okay? Well, there's another thing which I have in here for you. I mean, aside from what's happening within our industry and what's happening outside of industry is quite interesting. And that's something that we should actually think about it. And one of these is that this is just only a few days ago, Goldman Sachs actually reported that for the first time, the spending on the renewable energy is going to surpass the oil and gas. That's actually, is the game changing, in my opinion. That's something that we need to be really carefully watch for that, right? And if you have had a chance to look at the Bloomberg New Energy, data that they have, one of the key factors for renewable is that the cost, right? How much is going to, how much we're going to spend to generate the energy. And apparently from 2010 till now, within 10 years, reduced significantly the cost of what we can generate the energy from those renewables, right? And if you look at the perspective of the global power generation, remember the electricity is going to become, the main source of wherever we're going to use for industry and housing, transportation, heating, you name it, right? And if you look at where we are now versus what's going to happen in 2050, right? It's really a lot of things is happening, particularly the fact that if you pay attention to, is that almost like 50% of those energy is going to be coming from wind and solar, right? Well, gas is still going to sit there, I think pretty okay. Coal is in the bottom. I don't think that coal is going to go away, for various reasons, which I'll go over if you want to. But certainly that's a kind of a change that you can see, the shift, I would say, for the energy industry that we're seeing out there, right? Now, where we are now, 2019, we start seeing, electrical cars. A lot of the car manufacturing is actually focusing and funding, investing on the electric cars, and I think that's going to become quite normal. And I don't know how many of you are using electrical cars or not, but that's something. But other thing is that you think about how many smartphones are we using. that should need, electricity to be, to charge, right? Interesting enough, yeah, we still, in the total sum, somewhere around 70%, of our, electricity is still generated by, the fossil fuels. But what is interesting is that 17.6% is still coming from renewables. And what is more interesting, if you just look at how much states are producing their electricity from renewables, interesting enough, is that Texas is the number one, right? Quite interesting. But at the same time, we're producing a lot of oil, right? The last slide I have for you, the energy transitions. I just wanted to have you just think about be mindful about what's happening in the industry and that transition. And I think something that I can see that is happening is, again, the policies and the priorities in terms of the global versus the regional and local. And I can see that, there are a lot of things, especially for the oil and gas, transitioning from global to more local. That's what I would say is happening as just a macro trend. I want to stop here because we have only 15, 20 minutes to go over the questions, things like that. I appreciate the opportunity to meet, Fred and Farrokh, and I look forward to hearing your question. Thank you.
Thank you so much, Dr. Mahmoudkhani. That was very interesting, a broad view of where things are going. And I'm always, the recent time, especially recent days, I've been monitoring Tesla's stock price. I know this is very short term, but despite everything else more or less going down, Tesla is going up. Maybe that's an indication as well for where the electric car is going, industry is going. And there is another, I think, company, NIO, is I think Chinese. They are amazingly strong and going up as well. So I don't know. So thank you so much. Now we're moving to our next part of the session, and that is Q&A. And here I like to go back to Farrokh Pebdani, a good friend of mine. Farrokh, you have been really patient and listening to the talks. I'd like to hear your opinion about what we heard today. Iman and Amir have been presenting their views. What do you think?
Thank you, Fred. Thank you for the opportunity to be part of this webinar. And I want to also thank Dr. Nasseri and Dr. Mahmoudkhani for their presentation. Excellent stuff, very insightful. I fully agree with Dr. Nasseri's forecast for the price range of the $35 to $50 a barrel over the foreseeable future. And long term, it's anybody's guess how renewables will pinch the oil and gas demand. The only caveat there is if there is another black swan. You cannot predict what's going to happen over the next 12 months with this virus. If there is no vaccine developed soon, things could be really, really different, especially in the fall where we have the flu season starting. This could compound the situation. But if you look at, for example, places like Australia, which is now winter there, things are not really that bad there. They're sort of under control. So I think this black swan may not happen. Going to Mr. Mahmoudkhani's presentation on the move to renewables, yeah, I think that's the direction. And the renewables, whether it's 2021 when the investment really picks up, again, it depends on the impact of the demand and the situation with the virus. But the trend is there. The trend is your friend, so don't fight it. If Tesla stock keeps going up, if NIO is going up, so those are really following the trend, following the younger generation who believe in this climate issue, and they want to change by switching to renewables and less demand for oil and gas. But at the same time, remember, coal still one of the largest generator of electricity. And it's just Germany that just announced that they totally are going to wean off the coal for electricity generation. So to summarize, yes, all we heard is correct. Forecasts are very reasonable. and demand, and the trend is towards renewables.
Thank you. That was a good as well, summarizing what we heard today, and your thoughts are really right on. The question that is probably in all our minds and our audience as well is where all of this going, and how is that gonna impact the job market for professionals in our industry. Right now, companies unfortunately are still shedding staff. So when do you think the hiring could start? And maybe if you can add the hiring, I think, is right now should be steady in alternative energy sources, right, or not. So if you can comment on that. Let's start with Farrokh, with you, and then we go around.
Sure. I think the near term, let's say next 6 months, the prospects are not very good because the companies will continue. They have promised the streets that they will cut costs. To cut cost means the easiest cost is labor cost. So to save cash, to pay their dividends and to move forward. But starting in 2021, if things are returning to normal in a fashion that we think that Iman said, around $50 per barrel oil, I think companies will have to start hiring because you need the manpower. Even you mentioned at the first on, we are reaching a bottom in terms of rig activity. And you in your table, you showed Canada added 9 rigs. So this is slowly going to start bringing people back by the first quarter next year. That's purely a guess. I really cannot elaborate any more than that. I would say first quarter next year is the starting point.
Amir, what do you think? You have been looking into the future a lot. So what do you think and probably you have more insight about which sector, oil and gas or the competing alternatives?
Right, I think what we have, I shared in our Telegram channel that about the job loss, especially in the service company side of it, it's quite significant, right? And even if you look at the slide that Iman presented in terms of the forecast, assuming the recovery point from the COVID-19. So till 2025, we are not going to go back to the trend that we were hoping to be at, right? So I'm going to say I have a strong feeling that probably 80% of those job loss, if maybe 50 to 80% of those job loss are not going to come back. And the way I see it is that even if you look at, usually it is, it started off from small companies, those who have a limited, pockets. They start cutting deep, right? Then goes to the mid-size and goes to the, the big-size companies, right? So you can see that thing now is happening on the top level, the top tier 1 type of producers, right? And it's going to go back to the next one and such, right? So I think there's a optimization happening around that point, right? I'm sure, you have a lot of network. You are in LinkedIn every day. You see those posts, that was my last day, things like that, right? And that comes from the fact that, that recovery is going to be slow, right? For a fact. But what happens is that at the same point is that I think the trend, what I see on the, in the field at least, I'm not talking about, the midstream and downstream. But on the field side, which is the upstream part of it, there's a lot of things happening for automation and reducing that, headcounts, because that's probably the most expense that they have, right? Now, there's also another thing happening that kind of maybe part goes to that macro trend is one of the things I noticed that the big companies started selling their fuel refineries. You probably noticed in the, in the news, Shell is doing that, BP has started doing that part, as well as the others, right? This tells you something is happening in there. And that could be part of that things that they have going both like that net zero type of activity, right? So that's what I'm thinking. That's what I said in my last slide. There's a transition of the policies going from global to more regional to the even local, right? That's happening on the producer side. I can see that happening also on the service companies too, right? That's what I see so far. Anything can change. Of course, some of it is related to COVID. Of course, the immediate market need and things like that, the demands, daily demand, things like that. But I think maybe more than maybe half of it at least is coming from pre-COVID. This was happening. I think COVID just accelerated that whole thing.
Perfect storm, huh?
Yeah.
So, Iman, what would be your advice for in the same direction of we are going the discussion? What would your advice for young people? My son was a freshman this year at Texas A&M engineering. He has ambitions in petroleum engineering. So, what would be your advice for young people like himself or those who are early in their career? Where we're going, is there hope?
Yeah, I want to agree with everything that Dr. Mahmoudkhani and Mr. Pebdani said in its general, but I want to add some positivity and some hope for your son and the new generation. First of all, for the current labor basically market in the oil industry, I think there was a big bump. And it may take a while to basically come back out of it and get to where we were in 2019. But let's assume that it may take basically 2 years or so to go back to the same market, same job market. But in the longer term, the current labor force are going to survive. What I'm showing here is that the oil demand outlook, and this is again, not our wishful thinking, but rather based on bottom-up approach of gathering some facts and information on the ground. We have definitely included a lot of change and transformation, including electrification of fleet, including renewable development, which also slowed down because of the oil price. You know that the oil price going down is not good for everyone, basically. Even for renewables, they need higher oil price to justify their development, their investment and everything. But we still see that the oil price, the oil demand to grow by another, let's say 15 million barrels per day from what it was in 2019, not from 2020. And that means another 15 million barrels per day of production on top of what we're producing today. Remember, a lot of our current oil producing fields and countries are basically on their sunset side. We see how North Sea production, UK, and a lot of other examples around the world, including the rapid decline rate in the US. Hence, there is a lot more work, job, and industry is going to work hard to add another 15 million barrels per day of production to the current plus dying oil from now until then. So we need, in fact, a lot more than 15 million new oil to add to the market. And if I show this curve for you, extended to 2050, the oil demand in 2050 is still more than 2019. So it will plateau and decline. But by 2050, we're still producing 100 million barrels per day of oil. And remember, many of that 100 million barrels per day do not exist today. And many of our current oil today do not exist there. So the industry keeps going. We still need more development, new techniques, increased recovery factor. That 2 to 8% wasn't 2 or 8 a few years ago, and it can go to 10 or 15. So there's a lot more work to do. And refining, yes, the mentioning of refining closures, Is a good thing because the downstream industry is a sunset industry. We can't expect more investment into new refineries, but we have a lot of refining capacity that we need to maintain. We need to basically renovate and add secondary units and downstream capacity and petrochemical units to that. So the job market in medium to long term is good and can exist and can even expand. But there is this bump ahead of us that we need to get out of it in the short term.
That's the nature of the beast, huh?
Yeah.
we know that. So thank you so much. I like maybe to go back to Farrokh and ask him about where do you think in the short term where we are with OPEC plus, with US shale, are they internationally, the global market, are they really holding to their limits, or what do you think?
We talk about the compliance of the OPEC cuts.
Yeah.
Well, I think in general they are. It's too early to tell because it went into effect. Iman showed the last month's data, but there was some rumbling that a few countries didn't comply. But they're small numbers. In general, I mean, it was Nigeria and I think one other country, I forgot. Anyway, so compliance is there, but it's not 100%. We don't have the final numbers for June and July. And if demand doesn't pick up, then we still have the excess problem. It goes back to what's going to happen in the second half with regards to the virus. And if there's additional lockdown, and if these lockdowns continue, you're in Texas, you just heard from the governor that if the things are not coming under control, he will not hesitate to have another lockdown. This will impact the demand also. This year, 2020, has been a very strange year. I can't wait for it to be over, and let's see what 21 brings.
Yeah, we all, I think. Thank you so much. I think when I look at let me look at the time, it's 1:59, so Houston time. We are there at the end of our time. If maybe
can I add a 30-second comment?
Yeah, why not? Let's go around and let's have some closing comments from you all.
Well, I think I made my closing comment, but just on this OPEC compliance, I want to say that the compliance, we basically found it over 100%. But the problem is that compliance to a target, which was not enough. So they cut more because they needed to cut a lot more than what they agreed to. So the compliance is no longer the OPEC target, or the OPEC compliance is no longer a good measure. It's for them. And yes, it shows how much they have done with what they committed, but they committed to less than what they needed to.
Okay, thank you. Let's go around the table and have maybe your closing thoughts. Amir, what is your thought? How would you let's just make a comment for closing here.
Sure. I'm going to say, don't be scared about what I said about those jobs that are not coming back. I think it's going to change. We need a different skill set nowadays, considering those things, the difficulties and challenges our industry is facing, and also adapting those to the ESG program, things like that requires a new skill set. There's some soft skill set that should be adapted. So don't tell your son that he's not going to be in job, has no job in oil. I think it will be definitely, I agree, it's not going to go away, but it's going to change. And that's just, adapting to the skill set. If I have a chance, hopefully the next time, I will probably can deep dive and tell you what I see, in terms of the new skill set requirement. So
looking forward.
Good. Thank you for the opportunity, everyone.
Thanks, Amir. Iman, what is your closing thoughts?
As I mentioned, I tried to make every comment. There are a few points I basically put on the chat box in terms of questions, but it's very important to note, basically when it comes to renewables, that it is definitely expanding business. It's expanding business, hence the stock market for Tesla is booming and all of that. But it has a long way to become a mainstream energy source. And if you only look at the electrification, everyone's quoting how many percentage of growth in terms of EV sales, but compared with SUV sales in California, and you will see that it has a long way to go to get to where the gasoline, petrol, gas oil, and SUVs, the basically gas guzzlers, are selling today. So the oil industry is not going anywhere. It just, the growth slows down gradually, but it's a massive monster to disappear. And by then, basically the market still goes on.
Thank you. Farrokh.
Okay, very briefly, the jobs, it's a transition. Okay, the jobs may be eliminated from the petroleum industry, but they will go to another industry. I would consider the renewable as part of the energy industry also. So there has to be a transition from this kind of skills to a different kind of skill sets. And if you remember that Iman said by 2050, we need another 15 million barrels of new oil. All these reservoirs are not going to be young and produce at those high barrels. That means they need more wells, more operation, more challenges are going to be ahead. So they have to hire. So the hiring has to come back and has to be maintained, and in fact has to be increased. And the companies like BP and Shell, who've decided to sell downstream because of the pressure from the environmentalists, somebody else is buying it, right? They're not going to just buy them and shut them in. Somebody else is buying, taking advantage of opportunity for these companies to take a loss, and those jobs will not be eliminated. The only area that can eliminate some jobs, which with the growth that will be also recovered, is automation. Like in the old days, if you wanted to go and check every well in the morning, you had to have the person to go on each one. Now you have drones doing that, and each pressure, it has a sensor that you collect that. So automation, but that created jobs for the people who developed the drones and developed the software for those. So in net overall, there will be more jobs, there will be more operation, people will be busy, and things will just improve with time.
Thank you very much. That was a really good closing. And thank you so much, Farrokh, Iman, and Amir. Really appreciated Hamid Reza for organizing this session. I hope our audience has enjoyed the talk and maybe had some points to take with. Have a wonderful day.
Thank you.
I would like to thank all the panelists, moderator for insightful discussion, and all the participants for taking part in this event. And just for your information, a recorded version of today's session will be available in the APPH social networks by end of today. Thank you and have a wonderful day.
Thank you so much. Bye.